buy low, sell high. Essentially, we all want to purchase at the bottom of the market and sell at its peak. Here we can see a market bottom, as indicated by the tool. Let's execute a buy order and monitor the outcome. Set the stop loss just below the channel of the indicator. Aim for a risk-to-reward ratio of 1 to 1.5. Allow the trade to unfold, and it turns out to be profitable. Now, we have reached a market top, which suggests it's time to enter a short position. Place the stop loss above the top of the channel. Set your take profit at 1.5 times the risk. Let the position play out, and as expected, the trade was successful. Ladies and gentlemen, this is the TopG indicator by BigBeluga. It's a tool designed to pinpoint market peaks and valleys, making it easier to identify trend reversals. In this video, I'm going to explain what this indicator is and how you can leverage it in your trading strategy. If you find this video helpful, don't forget to drop a like. Let's dive in. To add this tool to your chart, head over to TradingView and open any asset you prefer using any time frame. For this example, I'll be using the 15-minute chart for Euro USD. Now click on the Indicators tab, search for TopG and select the TopG indicator by BigBeluga. You may wonder, what exactly is this indicator? The TopG indicator by BigBeluga is a technical analysis tool that helps traders detect market peaks and troughs. Its simplicity and focus on market extremes make it especially useful for traders aiming to time their entries and exits in both trending and range-bound markets. As you can see, it's a straightforward tool that consists of several key elements. First, there's the trend channel. The upper band represents the top and the lower band marks the bottom. At the center of the channel, we have the midline. These bands serve as vital reference points for analyzing price movements. They can be used to identify potential support and resistance levels, aiding traders in deciding when to enter or exit trades with greater confidence. When the price approaches the upper band, it may suggest overbought conditions, signaling a potential reversal or resistance. Conversely, the lower band indicates oversold conditions and a possible support zone. The midline functions as a dynamic equilibrium, helping traders assess whether the market is strongly trending or moving sideways. The core components of this indicator are the top and bottom labels. The top label appears when the market is likely reaching a high probability top or an overbought condition. It signals a potential reversal to the downside, making it a good time to consider exiting long trades or entering short positions. And this label is based on price action signals that suggest market exhaustion or resistance. On the flip side, the bottom label, marked with a G, represents a high probability market bottom or an oversold condition. It suggests a possible reversal to the upside, indicating a good time to enter long positions or close short positions. And this label reflects market conditions like low volatility or momentum shifts, signaling a potential rebound. You'll also notice the caret and inverted caret symbols, which represent intermediate signals. The caret suggests a potential bottom area, but with less certainty than the G labels. These are secondary signals useful for traders monitoring reversal opportunities. The inverted caret signals a potential top area, but similarly, it carries less weight than the top label, offering extra context for traders in range-bound markets. So, how can we use this indicator in practice? Let me explain. But first, let's take a look at the indicator's settings to see how customizable it is. On the Inputs tab, we have the length setting, which defaults to 150. This controls the number of bars or periods used to calculate the range and dynamic bands. A higher value, like 150, results in smoother bands with fewer signals, capturing a longer-term view of the market. Lowering this value, however, makes the bands more responsive to recent price movements, producing more signals but potentially increasing noise. You can also change the main color of the indicator. For better visibility, I'm going to set it to bright yellow, leaving the length at 150. On the Style tab, I'll turn off the midline for a cleaner look. Once that's set, click OK. Next, let's add the MACD indicator so we can cross-check our strategy. Double-click it to open the settings. On the Style tab, disable the MACD line and the signal line, then click OK. Now that everything is ready, let's go over the conditions for entering trades. The strategy here is to use the TopG indicator to spot market tops and bottoms. However, Before entering positions at these critical points, we'll look for divergences in the MACD for added confirmation. For a long trade, first identify a bullish divergence on the MACD. This type of divergence has three key elements. Look for the initial MACD low forming at a clear trough, then allow the MACD histogram to rise and form several green bars. Afterward, the histogram should create a second MACD low, this time with a series of red bars. Ensure that the first MACD low is lower than the second one, confirming a bullish divergence. Next, draw a line from the middle of the first MACD low to the middle of the second MACD low and compare it to the price. If the price makes lower lows while the MACD shows higher lows, that's your divergence. Within the divergence, look for the G label, indicating a potential market bottom, increasing the chances of an upward movement. Once the MACD histogram turns green, signaling bullish momentum, enter a long position. Place your stop loss just below the lower band and set your take profit to twice the risk. Let the trade play out, and in this case, it was profitable. For a short position, the process is the reverse of the long trade. The first condition is to identify a bearish divergence. In this example, the MACD created two highs with a low in between. The first high was higher than the second, meaning the price made a higher high, but the MACD made a lower high, indicating a divergence. Once you spot this, draw lines marking the beginning and end of the divergence. Look for at least one top label within these lines, indicating the price may be overbought and due for a bearish reversal. Once this is confirmed, wait for the MACD histogram to turn red, signaling increased bearish momentum, and then take your short position. Set the stop loss above the upper band and the take profit at twice the risk. Allow the trade to run, and as expected, it was profitable. To sum up, the TopG indicator by BigBeluga helps identify market tops and bottoms using dynamic bands and labels. When paired with MACD divergences, it enables traders to spot high probability reversals and execute trades with clear entry, stop loss, and profit targets. That's all for today's video. I hope you found this helpful. If you did, please consider giving a like or subscribing for more content. And it would be great to see you in my free Telegram trading channel where I reveal my private systems. The link to join is in the description below. Thanks for watching, and I'll see you next time.